Recording in progress.
Video, we will look at the question number 1 of SBR March 2020, June 2021 exams. Right, so straight away move down to the question. Here it is. Firstly, we will have the relevant information over here. We have 3 exhibits. In exhibit 1, you will get the information related to acquisition of Peru company. In exhibit 2, you will get the information regarding Peru company net assets as at 1st July 2000 X5, and in the exhibit 3, Colombia company pension scheme, right? So we will come to this information later on. First, let us look at the requirements. Firstly, it's asking draft an explanatory note to the directors of the Colombia company about to address the following issues. Okay, first issue, whether Colombia company should be considered the acquisitor in the business combination with Peru company, right? This will give us 9 marks, right? So let us move requirement by requirement. Going up again, Colombia company is a parent of the listed group which operates within the telecommunication industry. During the year ended 31st December 2005, Colombia company acquired new subsidiary and made adjustments to its pension scheme. The group's current year end is 31st December 2005. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Acquisition of Peru company contains information related to the acquisition and consideration paid for Peru company. Okay, number 2, Peru company net asset on 1st July describes the valuation of the assets of Peru company. And number 3, Colombia company pension scheme. Right, so we have to go on the number 1 exhibit. Brazil company is a competitor of Colombia company. On 1st July 2005, both Brazil company and Colombia company acquired 50% of the 5 million ordinary $1 shares of Peru company. Okay, the consideration paid by the Colombia company consisted of cash of $8 per share and also 1 for 20 share exchange when the market price of the Colombia company's shares was $10 each. Okay, Brazil company also paid 8 per share for their interest, but did not issue any shares to the original shareholders of the Peru company. The ordinary shares of the Peru company have 1 voting right each. Following the acquisition, Colombia company had the contractual right to appoint 60% of the board of Peru company. Okay, with the remaining 40% appointed by the Brazil company. So here, Colombia has more rights. Okay, while Colombia also gave 8 per share and 1 for 20 share exchange when the market price of Colombia shares was 10 each. Okay, Brazil company has voting rights over any amendments to the articles of incorporation and also over the appointment of auditors. Okay, Brazil company and Colombia each appointed 1 member to the board. So here the power is equal. Senior management team. It is a senior management appointed by Colombia company. Okay, who makes the key decision? They have here again regarding the development of Peru company, new technology, its principles, revenue stream, the markets that it will operate in, and how it is financed. Okay. The senior manager appointed by the Columbia company also provides a supervisory role and the right to request that significant activities get board approval, such as imposing restrictions on Peru company for undertaking activities that would significantly increase credit risk. Okay. So we had to refer the first exhibit for the part A1. That's it. So let us move to the drafting of answer. Okay. For that, just a second. It's screen and here it is. Now, let us start drafting the answer for you. What we'll say over here is 1A 1 yeah 1A 1. So what we will say, an acquirer is the entity. First, we will describe the principles of IFRS 10 consolidated financial statement, right? So just firstly, we will simply give the knowledge of the standard firstly. So an acquirer is the entity which has assumed control over another entity in accordance with IFRS 10 and investor controls an investee where it has power over the investee, exposure or rights to variable returns, from its involvement from its involvement with the investee and the ability to use its power over the investee to affect the amount of the investor's return all right. There are now what we will say that there are number of factors which should be considered when determining the relative share of ownership it may look at first that Colombia company and Brazil company have undertaken a joint venture where the two parties share control over the investee. This is because both Colombia company and Brazil company have paid an equal amount of $8 per share. Okay. Additionally, Colombia company and Brazil company have undertaken a joint venture sorry, Brazil company both paid an equal amount of $8 per share. Right. Additionally, Colombia company and Brazil company each have obtained 50% of the equity interest and have equal voting rights of one vote per share. Both entities satisfy the criteria for rights to variable return. However, however, joint control relies upon there being joint control over all the entities or all the key operating and financing entities, financing decisions of the entity. Thus, so here scenario does not indicate that an anonymous consent is required because decision making responsibilities appear to be split between Colombia company and Brazil company. All right. Second factor. The second factor to consider who has the right to appoint the majority of the governing body. Colombia company can appoint 60% of the board. Suggesting they may be the acquirer. From other side, Brazil company have additional rights in terms of the power to veto amendments to the articles of incorporation and the appointment of auditors. So in the assessment of control, it is important to consider whether these rights give Brazil company power over the investee and whether it can use this power to affect their return. To affect their return. Further, what we'll say, in this assessment, it is important to differentiate between substantive rights and protective rights. Only substantive rights can give the investor control. These rights uh, are more likely to be considered protective since they appear to prohibit changes in the activities of the investee, which Brazil company does not agree with, rather than give Brazil company power. These are not rights which would allow Brazil company to affect the profitability of Peru company and subsequently their return. Protective rights do not prevent Colombia company from obtaining control. Right. So far, uh, till now, as you can see, what I did, I'm use the standard knowledge and then simply connecting it with the points of scenario, and we cannot assess till now that who is the actual acquirer. So we can argue further for it. We can say further a similar argument can be applied to the appointment of the senior managers, the entity which has the right to appoint the majority of the senior management team is more likely to be the acquirer, while each entity can appoint one senior manager each, while each entity can appoint one senior manager each. The rights of the senior management uh, appointed by Brazil company appear to be protective while all key decisions are made by the senior manager appointed by Columbia company. Right? The rights of the senior manager appointed by Columbia company therefore appear substantive, including requesting board approval for signature weekend activities. They have the rights over decisions affecting the key revenue earning capabilities of Peru company, including technological development, markets to operate in it, and ways of raising finance. Thus, Colombia company has power over the investee, and these rights enable them to affect their return. Now, finally, what we'll say that further evidence that Colombia Co is the acquirer is reflected by the share issue which Colombia paid as additional consideration to obtain control. It is often the case that the acquirer has to pay a premium on acquisition for their equity interest. Colombia company has to pay additional 1.25 million, 50% of 5 million into 1 divided by 20 into $10. Despite each investor acquire 50% of the equity shares. It can be concluded that Colombia is the acquirer in a business combination, and that Brazil company in effect is the non-controlling interest. That's it for this part of the question. I hope you get it. Now we will look at the next part, A2, which asking A calculation of the goodwill at 1st July 2005 explaining how fair value of both the consideration and the net assets have been determined. Okay. It will give us 11 marks, as you can see. Now what we will do, we will move to the here. We will move here. The net assets of Peru company reported in the individual financial statements had a carrying amount of how much? 32 million or on 1st July 2005. However, on the acquisition of Peru company, the directors of Columbia company discovered the following. On 1st January 2005, Peru company acquired 6 million 6% coupon bond for 6 million in an unquoted company at par. Bond is paid annually 31st December due to premium on the redemption. The effective rate was 8%. Peru company has a business model to collect the contractual cash flow from the bonds and therefore measures them at amortized cost. Colombia holds similar unquoted assets but has a business model whereby they may either collect the contractual cash flow or sell the asset. Bond with a similar risk profile for a similar quoted company where trading at 2 at par, discount of 30% is considered reasonable to reflect the difference in liquidity of both types of bond. One of the identifiable intangible assets of Peru company at the acquisition was brand. The brand had a carrying amount of 4 million. Okay. On 1st July, Columbia company has a similar branded product and is the future cash flow from the parent company product post acquisition are therefore considered to be trade. It is estimated that it could be sold for around 5 million. Peru company has several technical support service contracts for which there are outstanding performance obligation at 1st July 5 included in contract liability. Deferral income at this will cost 1.7 million Peru company and other market participants to complete. A markup of 30% is considered reasonable for this type of contract. Colombia company has a policy of measuring the NCI at fair value. Uh, right, done. Now let's dive in and write. Uh, Let us compute the goodwill. Okay, goodwill at acquisition should be calculated as follows. Cost of investment firstly, and what is that? Firstly, the cash of 5 million shares at 50%. We already looked at into $8. Okay, and then shares from the exhibit one. Here it is. Shares, 5 million shares into 50% into 50% divided by 20 into $10. We get 20, we get 1.25. The total is 21.25. Add fair value of NCI. It will be the copy paste 5 million shares into 50% into 8. We'll get 20, right? So it's 41.25. Less net assets As per question, we already highlight them in Exhibit 2. Here they are, right? As per the question, fair value adjustment. As per question, they are 32 million, right? Then fair value adjustment bonds. Fair value adjustment bonds are 2.16. Okay. Fair value adjustment brand 1, and fair value adjustment deferred income 0.59. That's gonna be total 35.75, and our goodwill at acquisition is 5.5 million. Right now, you might be wondering that how I got these fair value adjustments values. So it will be discussed over here. Here, IFRS 13 will be applicable. So fair value for IFRS 13 defines fair value as the price paid which would be received to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. This means that fair value is not entity specific. Entity specific, but rather should take into account a market participants' ability to generate economic benefits by using the asset in its highest and best use, or by selling it to another market participant who would use the asset in its highest and best use. Goodwill should be measured by deducting the fair value of the identifiable net assets at acquisition from the fair value, including non-controlling interest and CI of the consideration paid. In terms of the consideration paid, by Columbia Company for the acquisition of Peru Company, the fair value of the cash paid will be equal to face value. Columbia Company has paid $8 per share for their 50% equity interest, resulting in a cash consideration of $50 into 5 million into $8. That's gonna be 20 million. Thus, most reliable evidence of fair value is where an observable price for an identical asset or liability is traded on active market. The fair value of Columbia Company equity should therefore be measured using the market price of their own shares at the acquisition date of $10 per share. This results in a fair value adjustment of $50 into 5 million into 1 divided by 20 into 10. That's gonna be 1.25 million for the share for share exchange. Since the NCI is also to be measured at fair value, and Brazil Company paid 8 per share for their 50% equity interest. This will have a fair value of 20 million. Okay. In assessing the fair value of the identifiable net assets at acquisitions, it is important that the net assets of Peru company are measured using the same accounting policies of the group. Since the Columbia company has the same business model is to either collect cash flows or sell the bonds should be measured at their acquisition date, fair values, and treated as fair value through other comprehensive income investment rather than amortized cost. The fair value of the brand has to be determined in accordance with its highest and best use of for market participants, since it is not entity specific. The intention by Columbia Company to discontinue the brand is not relevant unless it is what other market participants would also do with the brand. Finally, the deferred income must be measured from the market perspective, since the market expect to incur direct and incremental costs of how much dollar 1.7 million in the performance of their obligations. The fair value should be determined. The fair value should be determined by adding the 30% markup to this estimate. The fair value of their obligations, the fair value added should be determined by adding the 30% markup, sorry, the fair value of, sorry, the fair value of of deferred income should be 2.21 million. That is 1.7 million of 130 divided by 100, which will result in decrease of liabilities at acquisition, and therefore an increase in the net assets of Peru company. Right. So this is the my model answer for this part of the question. I hope you get it, that how to draft the scenario. You got the technique. We'll see you in the next video with the next requirement of the question. Till then, ta-da.